Hey everyone, thanks for taking the time to watch this video. Ryan Hamer here. In this video, we're actually going to be talking about a conversation I recently had with someone regarding a phone call they got from their financial institution about restructuring their debt. And I'm going to explain to you why I said absolutely not unless you look at and consider the bigger picture. So let's get into it. So I'll paint the scenario. This individual has a line of credit, they have overdraft, and they have a credit card. And of course, the economy's crazy. Everybody's got a lot of stuff going on. And what's happening is this person, their credit card is over 50% utilization. Their line of credit is over 50% utilization. And every time they get paid, their paycheck goes into their checking account and they end up in overdraft or what have you, but the overdraft always gets covered. The minimum payment to the credit card always gets made, but they're always at a higher utilization. And same with the line of credit, closer to max. However, what's happened is the bank contacted the individual stating that they should consider a debt restructuring plan, or they can help them with that. And they said, okay, we'll be able to give you a loan so that you can pay off your credit card and pay off your line of credit. However, in exchange, what we are going to do is we are going to close your line of credit and we're going to close your credit card as well. So there are several reasons as to why I said no, or I would say no, and why I advised this individual to say no to that. If the bank is forcing it on you, that's one thing. That's a whole other video and story. If it is your choice where they're saying, have you ever considered, or maybe you might want to consider, you really have to look at the bigger picture. And the bigger picture is the reason why you don't want to close your line of credit, you don't want to close your credit card, and you've seen me talk about this in previous videos, your credit capacity. So it contributes to your available credit. If they close your $10,000 line of credit, or they close your $10,000 credit card, and they give you an installment loan of 20 grand, then sure, you have one item that shows that you're paying back, yes, but you're losing the other two. And once you pay off that $20,000 loan, you no longer have the revolving credit of the credit card. You no longer have the revolving credit of the line of credit, and you lose that credit history too of both of those items. So say that you had that line of credit, and say you had that credit card for years and years, maybe since you were a teen, because a lot of people open up bank accounts when they're young and they're offered credit products. If they're a good customer, they got money coming in, they got a paycheck coming in, and their credit is good, they will be offered products. And sometimes these products are grandfathered. Like when I say grandfathered, I mean they might have had them from when they were very, very young, in their 20s, in their teens, or what have you. So you don't want to lose that, and you don't want to mess that up. I mean, granted, with regards to the economy and stuff like that, you're going to go through pitfalls. You're going to go through times where you're caught up in the clinch in the meantime, and between times where it's critical. And it's important for you to have your credit card. It's important for you to have your line of credit. As you grow older, you might get married, you might have kids, or you might get divorced or whatever. And it's good to have that cushion with which you can rely upon when you're in a situation. A lot of people, heck, I did it, lived off their lines of credit as well as their credit cards during times of uncertainty. For example, during the pandemic, it was a very, very tough time for a lot of people. Some people got fired from work, some people got suspended. So you had to jack up your credit cards or jack up your line of credit just to get by. And people are still transitioning, and people are still recovering from that. And that's why you see a lot of financial institutions have a they have account managers for people that have large lines of credits or a large credit card. And what happens is they will contact them when they see that there's no movement. So they will have, these guys need work. They got to do their job in some way, shape, or form, right? So there are programs that run in the background that generate lists, right? There are algorithms that generate lists that monitor the clients and that say, okay, this person has a $30,000 line of credit, but they're close to the max and they haven't been able, or they're maxed out every month. They make the minimum payment, yes, which is great, but they're always over 50% utilization, close to 70%, close to 90%, whatever. So those people who are above 30% and more fall within a certain bracket, and those customers are on a list. They're on a watch list. Whether it's the line of credit or credit card, it's the same thing. And then what happens is they're contacted by the bank and they're asked, hey, what's going on? When are you going to make a minimum payment? Or when are you going to make a larger payment? When are you going to bring the balance down? What can we do to assist you? What can we do to help you? And that is something you need to keep in mind. They are not being maybe it sounds like they're being 100% altruistic, but not necessarily. Keep an eye on the bigger picture, right? Your checking account with overdraft is sometimes your saving grace. I know a lot of people that live out of their checking account, out of their overdraft, live off their credit cards and live off their line of credit. And I understand it. You got to do your best to try and keep the lines of credit, keep the credit cards under 30% if possible, but it's not possible these days with inflation and the way everything is going up as far as the cost of living. However, if you are in a situation where you owe a lot of debt and stuff, you definitely have to think about what your options are. So some people talk about a consolidation loan. Some people talk about bankruptcy. Some people talk about getting a consumer proposal. But in this case, we're talking about a potentially offered consolidation loan under the auspices of helping you, but they are going to close. They want to close your other revolving accounts. And that is something that you seriously need to consider. I wouldn't do it if it meant that I'd be losing my two accounts, because then you have to go through a whole process of trying to reapply for them once you pay out this loan or while you have this loan. And institutions might look at you and say, well, you know what? You have this big loan that you owe. We don't want to take that risk. And you closed your revolving credit accounts. And be wary of the fact that on your credit bureau report, what will it say? Will it say that the account was closed by you, the customer, or will it say that it's closed by the credit issuer? And therein is the crux of the situation. Because if it shows that it's closed by the customer, then that was your choice. But if it was closed by the credit grantor, then that was not your choice. And in a pseudo way, it looks kind of derogatory. It looks like it wasn't your choice. It looks like you couldn't handle the debt. And you don't want to appear that way on your credit bureau report. Should you need to go look for another line of credit, or go get another credit card, or maybe you're trying to buy a house or buy another house or something like that, and you have to have your credit bureau report printed and it's looked at, and that's viewed in a negative way. So that's something that you might not have considered. So, okay, Ryan, you don't want me to close a particular credit line. You don't want me to close the line of credit. You don't want me to close the credit card. You don't want me to take the loan. What do you want me to do? Glad you asked. So what you do want to do is try and increase your income in some way, shape, or form. Pick up a second job, or create a product or a business, or do something. I don't know, basket weaving, whatever. Get some extra money and try to pay down the other debts. Try to pay down those debts. Whether you use the snowball method, that usually works, or the avalanche method, that works too. The velocity banking method as well, that too. But the thing is, try to pay down the you can do it with the smallest debt that you have first. You can pay that down, or you can go with the one with the highest interest. And then you have to do some calculations to figure out how much is going to principal and how much is actually going to the institution, because there's like a little bit of a balance between the two. Now, why it's important for you to tackle the debt is so that they can see that you're throwing more than the minimum payment on the credit card. They can see that you're throwing more than the minimum payment on that line of credit. And why that's important, it's because you're touching principal. You're scratching principal. If you're just paying the minimum payment, you're only paying what you're obligated to pay and what they want you to pay, and that means you're sort of beholden to them for longer. So there's an old saying about how you cannot buy time. Well, if you look at your credit card statement, when you look at your credit card statement, it actually tells you that if you keep paying the minimum payment, then you will be paying this debt for X amount of years or what have you. So you can buy time in this regard, insofar as if you make more than the minimum payment. If the minimum payment is $50, then pay $100. If the minimum is $100, then pay $200, if you can. And the trick is if you set up an automated payment from your bank account. So as soon as you get paid on the Thursday, there's an automatic reminder, an automatic bill payment set up in your bank account that $50 or $100 or $200 goes straight to that credit card or gets transferred into the line of credit. And in that way, you're at least touching it. You're showing, you're paying it, you're making that extra payment. I know it's difficult. It's very, very difficult to make larger chunks of payments. But if you can do that, it will help you in the long run. So for example, if you have a credit card of $1,000, then the minimum payment might be like $50 or something like that, or $30, whatever. Pay $100, pay $100 to that. And if you do it off of each paycheck, if you try to do it off of each paycheck, then you'll be able to defray the balance quicker. And the more you put down, the quicker you can defray that balance. Now, when it comes to lines of credit, it gets a little more tricky with that, because you put the money in the account, but they're going to charge you interest on the total amount that you owe. So you got to keep putting money back, keep putting money onto the line of credit and not using it. If the money sits there, then what happens is it's less money that you owe back, obviously. And when I talk about this in other videos where we get into, how long or when should you make the payment and how long can you leave the money there. So the trick is, it's the reporting date, right? So once the credit card is actually reporting to the credit bureau, once that's done, that's usually done on the statement date. After that, then you can utilize the money. But before the statement date, no. Make the payment, let the money sit, let the statement date roll over, and then you can use the money for whatever. And then you have that window of time extended again until the next payment. However, for the purposes of this video, I just want to quickly explain to you as to why you got to pay that money, and just leave it there, because when the snapshot is taken with respect to the balance owing, you want it to show that, hey, there is a balance of, say, $2,000. $2,000 out of, say, $5,000, right? Or whatever the amount it is in total that you owe. And you got to chip away at that and chip away at that and chip away at that. And the only way that you can do that is if you manage your money responsibly, accordingly, and you try to get some extra money coming in to do that. And don't be afraid to utilize you might have a card that has quite a bit of money on it. You can do some balance transfers and stuff like that as well. But let's just assume, for argument's sake, that say you live in a house or you live in a condo or what have you, and you are up for a mortgage renewal or what have you. What you can do is, instead of you going to the bank or the bank coming to you and saying, hey, we're going to give you a consolidation loan, what you can do is, upon your mortgage renewal, you negotiate a refinance, or you negotiate a way to wrap those debts in. So say you owe $30,000, then you can add $30,000 onto your mortgage, gets tacked on, and sure, your mortgage payment goes up or whatever, but you don't have to worry about those two debts anymore. You don't have to worry about your line of credit, and then it's free and open and clear again in case you really have an emergency. Same thing with the credit card, and then you're free and clear again, and then you save your credit. That way, you're not obligated to say, all right, ixnay the credit card, ixnay the line of credit, and you're not losing. Sometimes the bank beats you. The bank tricks you. Sometimes the bank traps you. Sometimes even the A1 banks, they have their tactics and they have their tricks. And we normally don't call the big banks predatory. We normally don't. But sometimes they do things that are predatory. And I think in this particular instance, you have to be very wary of the situation. Also, if you found this video helpful, please feel free to like, share, and comment. And in the comments, please feel free to share and tell me about an experience that you had with the bank when they called you or they messaged you, emailed you, or sent you a letter or what have you, offering you an opportunity to consolidate or restructure. Because remember, they said restructure. They didn't say consolidate in this particular instance. See, the wording is key, and it's very interesting. You got to pay attention to the verbiage that is used, because in my mind, if they say restructure, I'm like, okay, cool. If it's consolidate, then that's something different too. So you have to keep in mind, how do they speak to you? What kind of words do they use? My name is Ryan Hamer. Thank you very much for taking the time to watch this video. I hope you got some value out of it. Let me know below. Take care. Till next time.